Welcome to the National Credit Awareness and Resolution Association podcast, your source for navigating debt repayment challenges during tough economic times. Today, we'll explore how to effectively use Creditor Tools, specifically financial statements that are stale or interim financials. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. We'll share insider tips to help you leverage this knowledge and strengthen your position. Let's get started. Interim financial statements, usually less than 1 year, are used by creditors until a full annual financial statement is issued. It will provide valuable information that allows the credit analyst to compare performance during similar prior interim periods and thus be able to identify any positive or negative trends. A good lender will ask why the trends are happening. For example, if the first quarter sales of the current year are compared to the first quarter sales of the prior year, whether they're increasing or even decreasing. This same holds true for the gross, operating, and net profit margins, not to mention working capital, cash flow, leverage, and debt service capacity. Current personal financial statements of the principals of the company will also be used by the creditor to assess the level of combined liquidity there is to sustain repayment if needed. Unlike the typical 3 years of required financial statements and tax returns due at loan origination, current financial information reporting will be required throughout the lending term, even on an interim basis. When the debtor fails to submit signed and dated financial reports when required, the financial information on file will be considered to be stale. Financial reporting may be due, for example, each month, or quarterly or semi-annually, for example, or even annually within, say, 30 days of each period end. Annual reporting may be due within 90 days of the fiscal year end, and tax returns within 30 days of being filed. Lenders like to lend with the lights on, okay? As part of the creditor's credit risk management practices, it will likely ensure the debtors receive notice of any pending reporting due dates and will certainly send notices when the debtor has failed to remit required financial reporting as per any reporting covenants. Not submitting financial reporting when due would constitute not a payment default, but a technical event of default under most loan agreement terms, even if the loan payments are current. Stale financial information is unacceptable to the creditor, as no creditor appreciates lending with the lights off, if you will, unless perhaps the loan is secured by cash. Without current information, there is a material lack of communication, and the creditor may feel like there may be a character issue or a breach of trust. Without the lights being on, if you would, the creditor has no way of seeing clearly what's happening. Loans subject to renewal will require current and timely financial statements, tax returns, credit reports, etc., and won't be underwritten on stale information if possible. So why is the interim and stale financial statements risk important to you? First, you must know what financial reporting requirements are expected. Right now, do you know exactly what financial reporting is due and when? Are you current on that reporting, or are you shying away from submitting the current interim financial statements because you don't want the creditor to know what's happening? You're not the first. Do you know that what your loan agreement specifically states, covenant-wise, as it relates to what financial statements and other documents are due and when? You can rest assured that the creditor will read the loan agreement and understand clearly what constitutes an event of default. When is the last time you read the events of default on your loan agreement? And does it state that not remitting such documents is an event of default? If so, what are the stated remedies available to the creditor to cure the default? Does the loan agreement also state that the underlying interest rate on your loan can be increased to the default rate if you fail to submit financial statements? If so, what would that interest rate be? Could you afford it? Indeed, creditors are both able and willing to declare a default and increase the interest rate accordingly. If paying the default rate doesn't get your attention, what will? To pay unnecessary hundreds and possibly thousands more dollars in interest expense at the default rate is clearly a waste of resources. If you're not fully aware today of what events trigger an event of default, you should take 20 minutes and read the loan agreement again. Notice the covenant section specifically. Next, is there any doubt that you really don't know what's going on or expected? Better yet, keep in mind the word ownership when it comes to dealing with your creditor. For example, while you have your loan agreement in hand, spend another 20 minutes or so reading it. Take it all in. Besides reading the events of default, look at all the covenants, including those agreements for financial reporting or financial performance ratios, affirmative, and even the negative covenants. If any loan subject doesn't make sense to you, then look it up, talk it up, and satisfy yourself of the expectations set forth in the loan documentation. If you will understand and recommit to the commitments you've knowingly made or unknowingly entered into, it's more likely than not that any Grand Canyon-sized misunderstandings with your creditor will be minimized. In periods of economic downturn, there is every expectation that you will comply with all the terms and conditions of your loan documentation. Obviously, there will be times when you cannot do so, regardless of your best intentions. But it's not as though you wouldn't be in default if you could have avoided it. That is when you will want to take charge and be empowered to repay your debt obligations as best you can. Make sure you lead out with current and accurate financial reporting that states the facts. Build a relationship of trust and make sure all your financial statement information is submitted on time, including any payments, and that your credit file is never stale. Finally, never inflate or underestimate the values of assets or liabilities on your personal financial statement. The creditor has tools and methods available to help confirm the veracity of the amounts listed therein. He will look to see if there are assets that might be available to help shore up the credit risk by having you pledge unencumbered assets to secure the loan, which you may be perfectly willing to do. Thank you for joining us. Today we discussed the Creditor Tool financial statement, stale and interim. As debtors prepare to propose their own repayment solutions, we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at NACARA.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thank you again.